Hey guys, it is May the 18th and the market is nuts. I mean, come on, it's so funny at this point. Let me share my screen. As per usual, past performance is not indicative. It always does. It's so frustrating. Past performance is not indicative of future returns. And, we've got, again, crazy day. Look how red all the indices are across the top. And it's even impacting crude. But you guys, there's no supply. So let's not be confused as to what's going on in the commodities market. Just because the market decides it wants to sell one day does not mean that suddenly massive amounts of oil have no end place to go. Additionally, when we look at how red this is, it just really tells you how kind of almost trigger happy everyone is as far as their positions go. In these kinds of markets, day traders can do fantastic. I get it. It's a very unique skill set to be truly able to trade such a volatile market. I mean, you've got big cap tech swinging around 3 and 5%. That's not normal because that does indicate that other things are going to trade around pretty aggressively. And I think the thing that we're going to talk about today is what happened in retail sales. I feel bad that like the last couple of days that we weren't around because of my travel situation to talk about it, because in a lot of ways, this is very anticipated for me, which is why I wasn't in a lot of retail. But it's also kind of this other thing that you could have seen telegraphed through CPI. So we're going to talk about, I'm going to do a review of CPI because I don't think we talked about that enough the other day when it came out on Tuesday. Additionally, we're going to talk about these earnings reports and what I think it's going on in the marketplace. And then I'm just going to reiterate a couple of things. So let's get into that first. This week was not about big announcements from the Fed. It really was these last retail items coming out, starting with retail sales on Tuesday and Walmart and Home Depot's earnings reports, but then filtering through. And I suspect that right now you've got a lot of folks that are just looking at the numbers and reacting. But there's so much nuance in these numbers this quarter that I think bleed into macroeconomic policy and what have you. And it's just a matter of time before I think everyone catches up to have a legit dialogue, because right now all I'm seeing is that the retailers reported terribly, and that's let's just pause. I'll get into that. Right. The other thing too that I want to remind you guys is this is a monthly expiration, and we do have the sell in May go away sort of situation going on. So you've got this really skittish marketplace that's like setting up in just the right way to be extremely volatile. This bodes well on the options market, more for net credit sellers than it does buyers. It also means that if you're a long stock and you have owned it forever, probably the better way to hedge it with a particular event coming up is going to be to sell calls versus buying puts, because the puts will be expensive. In all cases, though, each stock has its own deal, and it has its own feel, and it has its own way of trading. So if there's something that you're looking at and you want to talk about it, come find me if you're one of our subscribers. If not, you can put it in the comments. Hopefully you're just not seeing this a million years from when your stock matters. But we are entering that period where there won't be a lot of news flow. You'll get a few investor days that will happen. That'll be the bulk of it. And then you don't get another earnings report until you're well into June. So it really makes sense that the stocks would trade this way. The one big exception to that is your commodities world. In commodities world, at the beginning of June, you will get the OPEC meeting, and that'll give you a sense for what some of the other large oil producers may or may not be able to do to help us out. But really, even in the farming sector, which we love so much and we're very bullish on, you don't really get an indication on how the crop is going until we get well into June. And so the diciness of what we could see here is pretty significant. I do want to let you know, Deere is reporting earnings on Friday, lots of volatility. If Deere reports oddly, I'm going to say it that way, oddly, because I think right now with these earnings reports, I mean, usually I can just be like top line, bottom line, and then come back to it if I see something strange. But right now you have to look so aggressively through all the financial statements to see exactly what's happening in order to get a true picture of what's going on, more so than ever. Look, I do that no matter what, but boy, if I had to like eagle eye it every single time. The thing with Deere, and this is part of the reason why we're not going to be long or short Deere going in, and if anything, we're going to try to find affordable ways to hedge a little bit of the mosaic in both directions so I don't cap myself out on any upside. But remember, Deere is an equipment manufacturer and steel prices have been going through the roof. So it could be kind of a touch and go on how to think about what they would report. Ultimately, the farm sales equipment is doing fantastically. So if it ends up being a margin issue, then it might be a margin issue. That's where I'm a little bit worried. If for some reason they were able to stick every single penny over to the purchasers, which they might be able to, because Deere does have both a commercial business and a retail business. They sell to, smaller farmers, or they sell, lawnmowers to all of us, something like that. But they do have a commercial business. And given what's happening, both on labor costs as well as other things going on globally, it's just an unknown. To me, I wouldn't be able to know that. Maybe there's folks that are much tighter to Deere that would know that. But because of the uncertainty associated with it, I'm not going to touch it, because I do know that when these numbers come out, people don't look deeply enough into what's happening. And it's really easy for the market to have a knee-jerk reaction on Deere if it doesn't do exactly what the market wants it to do. Okay, I want to talk back about retail sales. This came up on Tuesday, and it's really interesting because the top line number was so positive, it carried us up pretty aggressively. And in fairness, this is correct, okay? The consumer is very strong. And I'm going to say that even with this entire market incredibly red, and with Walmart trading down 6%, everything else you're seeing, the consumer is exceptionally strong, okay? Period. Now, X autos, you've got a slightly different number, which means that and then autos, you can see how big this chunk is. And now I'm going to go to the component parts. And I want you to see that when they're talking about autos here, they're talking about, so food was up 8.2%, okay? And then you've got gas stations up 37%. That's really representing what's going on in gas. I want you to think to yourself, why is food, boy, those seem like big numbers, but really, I think the key thing to think about is, why is food only up 8.2%? I mean, that's the real question mark that we have, given what part of the farming cycle that we're in. I mean, we're in spring, right? So right now we're basically eating some inventory that was already produced either in another country, or alternatively through the winter months or through the fall months. We're just drawing down inventory. We haven't yet had any thought process on how this planting season would go or what's going on. So I want you to really understand that the component parts of these monthly sales give you a sense for what is happening. And my hypothesis as to what is happening, now you can see food services and drinking places, the restaurants are actually doing pretty okay. Starbucks, Chipotle, those guys are coming out great. And I will do a review of all of consumer once I get through more of these names, because boy, there's still a lot that I'm behind. But I always feel that way every earnings season. But general merchandise only up 2. It's really going to be relevant to look piece by piece on this. First, let's talk about this right here, which is food and retail. Why is it only up 8.2%? Now, Walmart basically had a top line growth of 4%. Okay, on the quarter, we're really not getting we're getting a much bigger kind of chunk up in some ways, but in other ways, it's not. What I'm saying is basically what Walmart said, and also what these net sales represent, is the idea that Walmart is eating some of this inflation. And they talked about the fact that they were willing to take lower margins on food to try to help out general merchandise. That is true in a couple different places. Now, the other thing that Walmart had that was a little bit different from Target, so we're going to go to Target next, but I didn't put the sales up here, but I'll talk through what I saw in the numbers. The other thing I really want you guys to see is that international, look, the comp store sales were still up 4%. It's not like we're the only one experiencing inflation. So some of this on volume, yes, but if you take out fuel, then you have a comp of 6% up, okay? How do we interpret that? One of the things that Walmart said was that part of what's helping them is the fact that their fuel prices are low. So they're almost using fuel as a way to bring you in, because it matters that you can fill up your car and buy all the things you need for your household at one spot. And so they're using, in some ways, both a ever so slightly lower fuel price. They're still getting good prices on their fuel. They're not being totally stupid as far as that goes. And also, you've got that ethanol mix that the President Biden has now allowed for, that is definitely at the Walmart tanks, even more so than other folks out there selling gas. But that is one of the places where they're seeing it. Look at these average ticket sizes, okay? And I didn't put the other page here from Walmart, but I want you to understand that the comp on Sam's Club, which we talked about in one of the previous episodes, that comp was 17, like the sales benefit increase was 17.5%. So it's really about people buying in bulk, okay? And then I want you to understand the implications of that to the larger picture of retail, especially, one that we've been bearish on is Amazon, but Amazon kind of, you just got to pick your spots if you're shorting it, because given how much it's gotten clobbered, that web services business is a real thing. However, let's just call it what it is. That web services business is paying for the retail business right now and some of the failures therein. But just realize that the international business, it wasn't like, honestly, given how bad the international business was, I'm actually somewhat impressed with Walmart. Now, I don't have the numbers on the slide, but TJMaxx had top line growth similar in this 3-4% range. So that's what's happening in the U.S. consumers. You're still seeing growth in sales around the 4%. Remember, they don't have the fuel business, okay? So there's no like taking out the fuel business to help them out or hurt them or anything like that. They're just a retailer. Operating margins came down 50%. Now, they had tough comps relative to last year, and they're still making money. People are still going to their store, but it's just kind of the costs portion of it. Raising that up as aggressively is not the easiest thing to do at the speed at which you have to do it. Now, remember, both of these guys did have a little bit of a labor cost hit. Walmart in particular mentioned that they had overhired during COVID, which was really a rare thing that I've heard on any call. And so they had to have some attrition in order to allow that out. Most people have been saying that the attrition is what they're trying to compensate for. And that's just something that we'll have to watch out for. So I got a little bit worried when I heard it on Walmart, and then I have not subsequently heard it from any other retailer, and certainly not the restaurants as well. Everybody else is just trying to hire a couple extra people because the attrition on labor is much greater than expected. Now, the other retailer I'm just going to talk about briefly, Home Depot versus Lowe's. Lowe's had a down year over year. So Home Depot still grew the top line and did just fine. Lowe's did not do that. And I almost think this guy is like, even though he was flat on earnings despite a declining revenue growth, I almost feel like he's setting himself up mentally as a loser. I don't really know another way to say it. The guy's decent. He comes from JCPenney. People got mixed feelings about what that implies as far as his acumen in different environments. I'm not going to go there because the man's hella successful. So, and I'm going to trust the board did some vetting as relates to what kind of strategy. But here's the thing. Home Depot grew revenues and was able to just shaved a little bit off of the bottom line, and it got clobbered. But in fairness, they're seeing fantastic dynamics for what's going on in their business. It is still the case that people are doing all kinds of stuff to upgrade their homes. And that was really the important thing, because people asked him, what kind of products are you selling? Are you selling products that indicate that the consumer's running out of gas? And he's like, no, we're selling products that indicates the consumer's trying to upgrade their home. So it's mostly people trading up to better flooring, trading up to better cabinets, trading up to better appliances, et cetera, so to speak there. Lowe's, totally different the way they're thinking about it. They ran out of paint as far as that goes, and they ran out of a couple other things. Be careful though. I'm definitely not saying go long paint, because the biggest input cost for paint is oil, and we can see very clearly what's going on there. So that's not really even it. Although I must say, nearly every company that sells into Home Depot, Lowe's, like Fortune Brands, et cetera, actually did really well. Now, Lowe's attempted to blame it on a cold spring, and Home Depot did mention that they did see a negative comp for the month of April because we did have colder temperatures for a number of different things. And quite fairness, the other guy that sometimes gets this colder winter and as an adjustment because of the types of mix does have some overlap is Tractor Supply, and they experience the same thing as well. They report much earlier than the two of these guys. So what we're really seeing here from all of that portion, and then I'm gonna get to TJMaxx, which has its own deal. What I'm seeing is that you do have some difficulty for these true, like big, they call it general merchandise, but it's really places that people shop when they don't, for the day-to-day. You are seeing them absorb some of the costs and still have to, and they haven't totally passed that stuff through. So realize that that is a thing, and we will be watching because I think that's going to change dramatically some of these inflation numbers that we've all been crying uncle on, but it actually might be the case that we should be grateful for some of the things that are happening on the retail side. Now, the last person that we want to talk about is TJMaxx, and I actually was I took off the position because there's no reason for me to retain it at this point, but it was only when I was long. The reason I was long and I was willing to take a bet there is because that management team has been fantastic in my opinion. Okay, the thing that they have understood probably better than any other retailer in my world is that they understood that the supply was an issue, and that if they could just do a really good job on managing supply, then they would be fine. And that's essentially what they did. They still have decent margins for the inventory that's coming in because, and remember, if you're Walmart, you got to take the price on paper towels and toilet paper and stuff like that. If you're TJMaxx, you could just choose what it is you want to sell. If the margin's not there, the margin's not there. So you're not going to do it the same way. Plus, they just did an amazing job with their buyers sourcing material. They continue to do so on the go for it. Now, there is a little bit of weakness that happened in their home goods business, and a lot of people freaked out, okay? Because even though TJMaxx is up a bit, I'm not sure if it's been able to maintain that in this red as heck market that we're experiencing today. Yeah, TJMaxx still up 8%. In fairness, it traded down, and 60 is really where it's been settling in. So it's not like that is a huge bullish move for TJMaxx, even though it's up 8%. It's really a retracement for the folks that thought it should be lower than that, in my opinion, is the way I'm looking at it. But the thing with TJMaxx is that they are taking advantage of the fact that the consumer isn't going to go to Macy's. They're not going to go to some of the department store areas and try to buy it there. They would like a little bit of a discount. The home goods was up against a very, very strong comp from the previous year. But now, as some of that starts to subside, and it will still look awkward, that business is doing extremely well as far as like if you just look at how much they're selling on volume and the such. And the reason it's doing well is because people just want to take it home. Your kid needs XYZ thing. You could buy it online, but sometimes they need it right now. Do you know what I mean? Or alternatively, your kids are going to college, you're taking them there physically. And yeah, I guess we can buy it on Amazon, but I kind of want my kid to have a comforter tonight. You know what I'm saying? So you're going to do that at a TJMaxx. You're not going to do that at Amazon. And a lot of the competition that would have been in that area is gone. And also because some of those stores are still trying to decrease their inventory, what have you, or they've just decided to like decrease the total store count, they are able to source the merchandise pretty good, which is kind of fascinating if you think about it, because we've gone through a couple of years of COVID at this point and a lot of store closures, et cetera. You wouldn't think that they could still find that scenario, which they've always benefited from, is when stores are closing and they just buy the inventory for cheap, but they are still capable of doing so. And that's what's happening at TJMaxx. Additionally, everybody, because of inflation, is a little bit more sensitive to paying up for different things. And TJMaxx, as a result, is getting fantastic store traffic, like foots into the store are actually really fantastic. And so that's why you're seeing great top line and bottom line growth. And the final thing that I just mentioned is that they actually increased their store count by 26, whereas other people are still decreasing store count. Now, that's not the hugest number, okay? Like 2019, you had people opening up everywhere. But you got to think, from a square footage, rental, all that stuff, they are still benefiting in some cases with the fact that they're still expanding, other people are not. And I want to be really careful when I say that, because I have listened to some of the real estate investment trusts that do retail. Grocery stores, they're doing great. The occupancy rates on some of the retail REITs that specifically focus in on high end, as well as with things like the fancy grocery stores. Where I come from in Florida, that's going to be Publix versus Winn-Dixie, okay, or Food Line or something. I don't even know if Food Line got by Albertsons or something, right? So the fancier grocery stores, the fancier strip malls, they're still doing great. You know, the ones that are doing more like your rundown areas, they actually, there's not a lot of REITs in the S&P 500 that do that business. There are REITs obviously that do that business. But I just don't have that intelligence for you today. But I do want you to just kind of get a sense for that. In the strip malls, they're still looking for really good tenants. We're still seeing, like, in the higher end ones, we're still seeing 90+% occupancy rates. My suspicion is that's unique to the higher end strip mall folks, not ubiquitous across all the strip malls. And let's see, the last things I just want to reiterate is, because we are going to get this crazy volatility, China, that one, it was very interesting because I was just finishing up Starbucks earnings call. And even though they're doing fantastic, they really are, the objectives that they've done, top line growth and bottom line growth, revenue, and bringing it down to net income, which is a big deal because they were having a little struggles before because the price of coffee was going up and they were trying to figure out the right mix. But things are moving in the right way. China, however, is it's a long-term objective for them. Is China? It's just really hard to model for them right now because no one really gets a great sense for the long-term impact or how long China is going to do this COVID shutdown thing. They're certainly doing it now, but it's hard to know when that will open up. And as a result, it's hard for them to plan on the shorter term, next 3 quarters, next 4 quarters. But on the longer term, Starbucks has zero desire to leave China. If anything, they're probably going to be taking advantage of whatever weakness shakes out due to this to strengthen their situation there. Other than that, let me see if I got anything. Nope. You know what? I'll go ahead and pause there. That's quite a lot. What kind of questions? Stop the share.
Hey, May.
Hey.
Overall, like Target, they grew their top line, right?
Mm-hmm. Actually, all these retailers did. The only retailer that didn't do something more meaningful than 3% was Amazon. That's why you get me so angry all the time on Amazon.
Anyway, so
still got to sell. I mean, what you do after you sell, if you messed up because you couldn't push it through on the pricing, if you couldn't push it through on cost, that's going to work itself out. Every business occasionally, sometimes price is wrong. You know what I mean? And that's what we're seeing across those two retailers, Walmart and Target, is really more that they priced it wrong on given the very aggressively shifting tides of cost structure. But nonetheless, all of them, other than Amazon had like flat top line growth, right? Walmart, despite taking a 17% hit, still posted growth on the top line, a 17% hit from international because those sales did not grow, okay? And then similarly with Target, you still had top line growth, okay? Only retailer that's not growing the top line is Amazon. That's what, anyway, you got me. Go ahead.
But so are you saying they did not pass along the price increase? Or is
Target and Walmart, correct. Right. TJMaxx, that's why I was willing to do TJMaxx as a retailer going in. I was not willing to do the other two because I just couldn't get any kind of real tangible feel for whether or not they were going to have to eat some of that cost. And then when I saw CPI, I was like, ooh, that doesn't make any sense. This number, in my opinion, should be higher, not lower, especially on food and some of the other things. Now, we still have the grocery stores, which, depending on how you look at it, will report first or last. So for me, they're last, but for other people, they're first. So when they come out, we'll see how much they ate it on food or if they're like still doing whatever they can do. Target, however, actually did a really good job on their branded food business. So Good and Gather, which a lot of people buy over at Target. I like a lot of their products. They got a lot of great snacks. That part is still very profitable. The problem is, I've been very unhappy with the fact that a lot of consumer staples companies continue to rally, despite the fact that their operating margins are at best a disaster, at worst a horrific disaster. Do you know what I'm saying? And so they have been desperate to try to push their pricing through. And so that's the parts with both Walmart and Amazon and Target. Although Walmart's got a little bit of extra other things that are going on, they're legitimately happy to eat the cost. The part that the part that is being negotiated as we speak is my suspicion. I can't be there to know if it's true or false, but it does sound like it from the Target call, is whether or not Kellogg's going to charge them a heck of a lot more for cereal, and they're going to have to figure out how to price that through correctly to their consumers, you know, so to speak. But on Good and Gather, where they're doing private label, you know, that's a thing. Now that also tells you something that's a little bit interesting. You know, the CPI, look, a 10% increase in food price, it's a big increase for sure. It's not a 36% increase like we're seeing in energy, but it could be, you know what I mean, given the fact that I'm telling you that the staples companies are eating it on cost and haven't yet had an opportunity to pass it through to all of us, and that the retailer also ate it. You know what I mean? You got two sets of people that didn't pass it through. So I haven't yet, obviously I'm seeing some of these earnings reports today, so I haven't processed it through all the way to say something relevant, but I think it's very important to think about it. The street won't have a chance to express its feelings about it yet, but I think it will drive us through the summer.
Yeah, you just brought up a good point. Is there a lag time? In other words,
there is. Yeah.
If you're paying for something that you're not able to sell for a couple of months, I mean, I don't know. I mean, you aren't even able to pass it through.
Yeah, that's exactly what happened as relates to cost of goods sold. In fairness, they do have some SG&A increase, meaning like you had increase in labor costs, you got some freight charges that were really painful. TJMaxx, that was the one area that they did not take into not taking into consideration is the wrong word, because they did such an amazing job given the environment. So here's the thing, TJMaxx, they went out and bought it. They knew what they were going to price it out at. The nature of their business model just benefits them because they don't have to sell you stuff. Like, you don't go to TJMaxx, and if they don't have something on the thing, you're just like, okay, no big deal. Whereas if you go to Walmart and there's no Colgate toothpaste, you're pissed. Do you know what I'm saying? Okay, so the business model is actually helping TJMaxx. The one area that got a little bit choppy for them, fair and square, they were like, this one is a little bit higher than we expected, was freight cost on the home goods piece. That's also part of the reason why they cited the home goods wasn't as profitable as it's been in the past, but they are seeing things just get swiped up off the shelf. Because, you know, you know, I always love, you know, I'm still a lady, so I do like to go into a TJMaxx and see what they have and what they're offering. And the fact is that home goods section it looks the way it always looks, which is like good inventory, moving out the door. Do you know what I mean?
Yeah. I mean, this backs up what you do. I mean, how could the street miss this so badly?
I know, it's really weird because CPI was a huge telegraph on that, and CPI is still showing the consumer buying stuff. Now, there was one other thing, in case I didn't say it really clearly, that concerns me a little bit as relates to CPI. And I think this might thematically be the conversation that people really start to have. And that is, you know, you got to pay for gas because you got to go to work. All right. And you got to pay your electric bill because you don't want to you can't, like, you know, in some cases you'll literally die. Like if you're in Arizona and it's 110 degrees, our air con broke down when I went to go visit my friend out there. It's not survivable. Do you know what I'm saying? And we got a whole lot of population that lives in those southern states. So you're going to definitely pay that bill, and you're definitely going to pay this bill. But what is the mix of stuff that you're going to pay in between there? Now, it turns out, I want you to look at this, and then it's hard to make this any bigger, but home furnishing and furniture, that's still a positive comp. Parts was negative, but the fact is we're still short a whole lot of cars. And also, if your car breaks down, you can't get to work, you're going to fix your car. Let's just be honest, right? So then you know, food and beverage, you know, you can't, you know, if you got money, you're still feeding your kids. It's really like sporting goods is down, electronics and appliance down 5. You know, you can see very clearly that in the next few months, until we fix this energy and food situation, the food situation, we know from Professor Dan that came through from KSU, that can't be fixed. That's a 2-year fix. You know, Mother Nature is going to need some time, and we're going to have a lot of prayer that we get some actual yield this year. And I got to tell you, you know, being out here in California, you know, the gentleman that we spoke to the other day, there's no rain. You know what I'm saying? There's a huge drought that are happening in the West. So if we're going to fix it, I don't know if the United States is going to be the one with this bountiful harvest to fix it. I think it's going to have to be Latin America that fixes it and make some progress on that. But Professor Dan was saying if we were lucky, it would be a 1.5 to 2 years fix. But if we're not lucky, it's going to linger for farther than that if we compare it to past droughts and past situations. So food, that's not going to get fixed. Energy, you know, thus far, I have listened to every single company in the S&P 500 at this point, right? So they're all bringing on capacity at like small little baby 10% is what they're thinking by end of year, okay? Some of it, they may be able to get through in the summer months, but not by much. And that's true whether we're talking about coal or which is not in the S&P 500, but I went ahead and listened to some of those because obviously we've got exposure through Consol Energy, ticker CEIX. But that's true whether it's coal or whether it is oil and gas or nat gas or whatever it might be. OPEC, like I said, they're not going to say anything until their next meeting on June, and then we'll get some thoughts. China being in shutdown is probably a saving grace for Europe because that's where that stuff would float to, and India. It would float there as well, but we don't really have a true understanding for what's actually going on because it's so much geopolitical posturing. But it looks to me like they have not shut down those pipelines yet. If they do, that should send ripple waves through Europe, which would benefit all of our manufacturers and heavy industries. That kind of is what it is. But essentially what I'm saying is we're not going to fix food or energy in the next 2 quarters. So that's really just going to be how exactly is everything going to juggle so that people can pay their bills and live a good life for themselves and their kids. Yeah, I'll hit the pause. I don't know if that was helpful. I just want to make sure that conversation I don't think is going on quite yet to the degree that it really ought to.
Well, the point I was trying to make is, you know, the street gets this stuff, you know, they're so far off. It's kind of
right
for them. So the next shoe to drop would be employment. I mean, if the consumer is so strong, which I believe they are,
yeah,
unless they start getting layoffs.
Say that to me again. What was the last part?
Unless they start getting layoffs.
The consumer is still strong. It doesn't seem like layoffs is a thing yet at this point, right? Like, so Walmart obviously, like I said, overhired, not obviously, because it wasn't obvious to me. I don't think it was obvious to the street that they overhired and had to let some of that attrition happen in the first quarter, but they're not, you know, but like pretty much everybody but Walmart is still like, we're really worried about employee turnover. Employee turnover is a problem for 2 reasons. Number one, because we got to find other people. But number 2, and more importantly, the people we do have, because they're so new at their role, they're just not as efficient because they got, you know, that sort of thing. So
you're saying there's a demand problem for hiring. Okay.
Yeah, I'm still seeing across I'm now at around, like, we'll call it 275 of the 400 that I target. And Walmart's the only one that had a different story as relates to labor. Literally everyone else, you know, everything from trains, you know, if you want to be if you loved playing with trains as a kid, guess what? They will absolutely be thrilled to hire you to play with the big trains, because they're still, even though they've done great work to try to just keep level set, so to speak, there's still demand there. Trucks, both long haul and short haul, is still desperate to find more folks. You know, and then there's a bunch of legislation that happened that makes it even harder to get your licensing, you know, in certain states, I guess it is. So that's kind of a weird thing as well. And then you got, yeah, tech is still always trying to find headcount. There's not one other place that I saw where people were like, oh yeah, we could let some go. You know, the only place that you're seeing layoffs possibly is like Netflix. Netflix is got bigger problems though. That's really a different kind of issue.
Well, I noticed in the hotel, on their remotes, the first thing you see is Netflix.
Yeah.
That was pretty cool.
Yeah. I mean, Netflix, look, it's not going to zero. Okay. Let's just be clear, but it has some significant strategy that it has to work out. You know what I mean? It used to be the case that they could, I get worried when a company states a strategy, but doesn't have a bunch of numbers to back it out or a trajectory for where it's going to go. Let me give a good example. Like, for example, with just so I don't have to think too hard, TJMaxx going into COVID when people were brutalizing all of retail, they were like, this is what we're going to do. We got the best buyers. They're going to source really good stuff. We're going to make sure that it's profitable. And we suspect that given how scared people are about this economy, they're gonna trade down and they're gonna be looking for discounts and they're gonna be looking for deals. In 2008, they were looking for deals and people did second guessed us and they were wrong and they're gonna be wrong again this time. That's a strategy, in my opinion, right? What Netflix said on the call was, yeah, kind of sucks. Our subscriber growth is down. We're gonna try a bunch of stuff and we're gonna consider advertisements. We're gonna consider this. We're gonna consider that. That ain't a strategy. That's you throwing spaghetti at the wall and hoping that it somehow helps your numbers. That's my beef with Netflix right this minute. Now, those are some smart individuals who are highly successful. So I don't doubt that the next quarter they'll have a little bit better and more to say and some more data points to help us feel confident that we're going to start to see those numbers uptick. But between now and then, I can't really give them credit for that last call. That was terrible. You're on mute. I don't know if you were going to respond to that.
No, I heard that. I mean,
okay, good. Yeah.
I mean, macro, macro speaking, you got a very strong consumer that Target, Walmart, they were not able to pass cost on.
It's a cost issue. That top line still grew. And I think that's what people are going to miss, and it's not the biggest growth but you got to think like the biggest chunk and shift of inflation upwards, other than gas, the biggest shift was actually the third quarter, the fourth quarter, and the first, this is the first quarter. We don't have that massive demand that's coming in from Christmas time. People can still modify what's going on a little bit. So the fact that we still see positive sales growth from these, to me, some of it is inflation for sure. It'll be much clearer once the grocery stores report, they'll be reporting part of January. In some cases, they won't be reporting January, but they'll be reporting the next like 3 months subsequent. So April, you got me. So some of them will start as like in late May, some June, et cetera, and then we'll really know how much people are eating this inflation on behalf of the consumer.
Well, they have to stay in business.
Of course they do. They're trying to kill their customer. You know what I'm saying?
But these are not luxury retailers. I mean, people go to Target. They're not going to stop going to Target or Walmart, especially. I mean, it's about. They're not going to stop going. And also, this was a really interesting thing that also I have not yet absorbed from Walmart, but I think it has certain implications in general. What we're going to see. They were talking about the price elasticity demand, big fancy econ words, right? And they were saying that because of the current environment, whereas typically you might have a sale and you'd sell some, you know what I mean? And you'd have some kind of supply demand thought process on what happens as you shift pricing up and down. They're saying that it's a much more loaded spring. Like they decreased toilet paper. We'll use something simple. They decreased toilet paper by 50 cents. And boy, the volume they sell is very different from what it used to be. And that's just really fascinating as well. And I think that to the extent that some of these guys are seeing a very unique environment, we haven't had this kind of inflation in a while. And that would indicate that that if the issue's price in for them relative to margins, they probably have to rework through some of those models. But I haven't thought that all the way through. That's just my impression of and translation of what Walmart was trying to say. One more point. I noticed a restaurant on their ticket added an inflation charge.
Isn't that weird?
Yeah, PR wise, so Walmart could do that, Target could do that. In other words, the consumer's going, okay, thank you. You're telling me why the price is higher.
Yeah.
It's probably temporary.
Yeah, I mean, I think that's correct. And as you know, and every single piece of people, every single part, all the way down, even in, you know, we're talking about consumers now, but even in the business community, you know, B2B type stuff, they're all doing something approximately like that. It's very interesting times, and you know, the thing with like the constraint is really known, you know. The constraint is coming from food, it's coming from energy, and it's trickling all the way down. That energy price issue is trickling all the way down. There's a lot. What's fascinating is so one of the things I've been investigating, but I don't again yet have a fully formed thing, so I won't go too deep into it, is the utilities companies. It is pushing them faster onto renewables. We do still have an infrastructure bill that has to come in here and help them out to fund that. You know, a lot of them are going to also modify the mix of what's going on. Some utilities companies aid it, and then others are using this to try to push through things. Like, for example, this one you'll care about because, you know, you're here in California. P&G, PE&G, is that your utility company? Ticker PEG?
Yes.
Okay, so they actually have some old nuclear power plants that they were trying to get funding for, but there's like a cutoff that the U.S. government puts for whether or not they're going to fund or try to decommission, and they're hoping that they're able to get money for upgrades to those facilities, because now that the energy price is crazy, there's not this antagonism in the same kind of way for nuclear. And they were one of the few utilities that is in my world thus far that have talked about nuclear and what they might be able to do just on the existing infrastructure that we've got there. So I found that fascinating. It's possible that in 6 months, we have a very different picture here in the United States, but it's going to be 6 months, not 2 to 3. It's going to be a minimum of 2 quarters, if not a little bit more, for the utility companies to try to come in here and help people out that way. That was kind of fascinating.
Yeah, great. Great show, May.
All right, cool. We'll end it. Good luck out there, you guys. Make sure you hedge, and see you tomorrow. Bye.